And on the topic of drawdowns, I really just wanted to remind listeners that drawdowns are a feature of investing in the stock market. They're not a bug of investing. Each and every year, the market does decline between 10 and 15% on average. Sometimes it's less than that, and sometimes it's more, but on average, it's between 10 and 15%. The other fact that's important to remember is that most years, the stock market finishes higher than it starts. So the red dots are the intra-year drawdowns that I talked about, between 10 and 15%, and the grey bars are the calendar year returns for the stock market, in this case, the ASX 200. So that's interesting, but what's I think the most important takeaway from this slide is the fact that if you were to actually rebalance your portfolio, take some of the cash that you have in your portfolio and invest in the stock market when it is down, you are taking maximum advantage of this phenomenon that we see in the stock market. So we are very firm believers in rebalancing portfolios, and even more so when stock markets give you the opportunity when they're down. I think this is one of the more interesting charts that I've ever come across in financial markets, which is that the point is that perfect foresight doesn't actually prevent drawdowns. And what does that mean? So what we're looking at here on the slide is the fact that if we had perfect foresight of the best stock performers into the future, that is, if we bought the best 10% of future performers before they were the best 10%, we would still suffer from drawdowns. We would suffer from around 10 drawdowns of more than 20% going back 100 years. So really key takeaway is that even if we did have perfect foresight and we knew what the best future performance would be, we would still suffer from drawdowns. And just to put a little bit of data against another old classic investor adages, which is be greedy when others are fearful. What we're looking at here on the slide is the fact that when volatility and fear is at its highest level, that is when forward returns tend to be the strongest. So if you know when that peak fear moment is, you can make a lot of money in the stock market. But the general principle is that when you do see volatility pick up and elevate it, that is typically a pretty good time to invest in the stock market. In fact, the best time to invest in the stock market. So in the US, if you were to invest in the top proportion of volatility periods, you would end up making over close to 10% per annum in the stock market, which is above long-term averages.